Certainly, I'm happy to be here and to represent the Chicago Fed and hear about what's happening out here in the lower part of our district. I would correct that we do not have all the state of Michigan in our district. The Upper Peninsula is in the Minneapolis Fed's district. But certainly we have most of the Cornbelt in our district, so it's great to see a lot of you that are helping to support the district's agricultural economy. I guess the one thing that is a little unfortunate in the timing here is that you're trying to digest your lunch, and I'm going to be talking about news that might give you some indigestion. So I hope that that's not something that is going to bother you, and I hope that I can give you some insights into what's been happening in the overall economy and then how it translates into the farming economy. And certainly I'd be happy to answer your questions either if we have time right after the talk or in the afternoon if you catch me. So, or you can always get a hold of me on our website. So I look forward to that. But before I actually get into the economy, I wanted to just relate a story that maybe some of you can relate to as well. My grandparents came over from Norway, and so one of my great uncles was a Norwegian bachelor farmer. And I don't know if you've ever heard of these individuals, but he had a friend, and this friend had a big corn and soybean operation, and he was trying to diversify. He decided he wanted to get into raising some chickens. You may not realize, but Iowa has one of the biggest egg growing farming operations in the world, and so there's lots of chickens there. And so he went to this store and bought some baby chicks and brought them home to the farm, but he had some trouble. They kept dying on him. And so he went back and bought some more, and then the guy that was selling him the chicks was like, why are all your baby chicks dying? What's the problem? And he says, I just can't figure out whether I'm planting them too deep or too far apart. And so I think that kind of illustrates a little bit of what agriculture is facing, in the sense that the economy is moving us in one direction. Agriculture has been moving in some other ways, but if you're not ready for risk and being able to manage the risks of your operation, then you're going to have baby chicks dying on you. So that's something that I think we all can benefit from thinking about, and certainly given the risks that we're facing, some of them like interest rates don't seem to be moving a lot in the next couple of years, but at the same time, there are plenty of other risks, whether you're thinking prices and corn and soybeans and those kinds of situations. So I have a lot of slides, and I'm a little compressed on time, but we'll try to whip through a few and then focus on some others that are maybe more important. And one that I'd like to kind of lead off with, because partly we produce it at the Chicago Fed, is a national activity index that takes hundreds of numbers and kind of crunches them down into just one that gives us kind of a quick look at what's happening in the economy. So if you're taking your pulse, or you're taking one idea on what's going on with the economy, this is one way to do it. If you look at the numbers that are above zero on this, it's where the economy is growing above trend. So maybe think about 2% roughly as a trend growth rate right now. And if it's below that, it's going to be below trend growth. And if it's way below, like -1, you can see you have a recession. You have a deep drop in economic activity. And right now, we are in that range between like -0.5 to 0 over the last half year, 6 months or so, and it's been bouncing around. But what that indicates is the economy is growing, but it's just not growing very fast. And once the economy starts growing faster is when we start worrying about inflation. And so if it was above 0 for an extended period of time, we're more focused on that side of our mandate. We have a dual mandate. And then now what you can see is we've mostly been below 0 over the last 6-7 years, and so especially when we had the recession. So right now we're more focused on unemployment, as the economy's too slow to generate enough jobs, and so that's one of the key issues. So right here in this one chart, you kind of have a feeling on where the economy is and maybe a little bit about where it's headed, in that even though it's bouncing around, there's no real strong trend at the moment. Well, when we step back to that period of the recession in, say, 2007, 2008, 2009, we had a time where there was a whole series of events that went on, and I wanted to just walk through you a little bit to give you a better idea on where we are right now. And you can see here in the area where we were about 2007 that interest rates had been rising. We were trying to get the economy from overheating. There was a lot of concern with the housing market and the boom and bubble there, and then the bust. And at the same time, when the recession hit, we started to lower interest rates dramatically. We needed to respond to that and to help stimulate the economy. But it really wasn't enough at that time, because we just had too many financial pressures, too many things happening, and the thing that needed to happen from the Federal Reserve's point of view was to expand our balance sheet dramatically to help deal with many of those financial crisis things that manifested in 2008. And so you can see here that we doubled our balance sheet approximately from under 1 trillion to almost 2 trillion here, with lots of special programs that were designed to help with specific financial problems that were cropping up during that period. And now, after that period's gone, a lot of those programs have been phasing out as we've been moving to help stimulate the economy in other ways, more open-ended ways. Here you can see the results of what was called QE2, where we expanded our balance sheet again, quantitative easing the second round. And so through this series of episodes of quantitative easing, we've allowed the economy to get a little bit of footing, but it hasn't been enough to really bring strong growth, and that's what I'll be focusing on here. One other little episode here is what we called Operation Twist, where we were substituting longer-term assets for shorter ones that were on our books. So we kind of moved out in terms of trying to lower longer-term interest rates more. So that kind of sets the stage in terms of monetary policy, that we traditionally would use that Fed funds target rate that lowers interest rates. And then once you get so low, I didn't point that out, but we were at such a low level you can't go any lower. And so then that was part of the reason that quantitative easing began to be used. And at the same time that we've had all these problems in the economy, inflation really has remained in check. It's very different than in the 1970s and 80s, when inflation was the primary problem that we were looking at in terms of economic situation. And here you can see that the yellow line represents the core level of inflation when you take out food and energy from the consumer price index. And it's been under 2% most of the last few years, even though it's edged up a little bit. But then you can compare that with food, and you see the variability in food prices here, where there was increases of over 6%, and then it dropped under the year-ago level for a little bit, and then it was up over 4%, and now it's back down to that level around 2% again. And certainly the situation here is one that we really have pretty stable prices. Prices are not out of control. At the same time, we have some concerns. Obviously, energy prices have been one area that has gone up and down and have really been influencing people in terms of, during the recession when energy costs were higher, they didn't have as much money to pay other bills and to do other things. But then now we've had some easing of that over time, and particularly when you look at natural gas prices. This is one of the things that's giving us a positive edge in the economy right now, that natural gas has become a much more plentiful and available resource for businesses and for enterprises, including agriculture. I just was hearing about CF Industries, I believe it is, in Sioux City is expanding their plant for fertilizer. So we're bringing back some of those jobs that were lost when we had the spikes in natural gas prices. So even though we've had some spikes in energy costs, they are not out of control. And when you include those into the inflation rate, it's still around 2%, maybe a little above. Next year, it anticipates to be a little above 2%. So, the dual mandate of the Federal Reserve is to maintain stable prices, not let inflation get out of control, but then on the other hand, to make sure we have full employment and try to reach that. And so that's where really the current discussion has been, that employment has, never recovered from the recession, and you can see here that we've been gaining jobs for a few years now, but when you lost over 8 million jobs and have gained back under 4 million jobs, you still have a big gap there, and that resource gap continues. And here you can see some of the effects in the Cornbelt. When you think about the major areas that are job generators around the cities, you can see a lot of differences in terms of the colors in Illinois in particular that changed. On the left-hand side, you see before the recession, relatively lower unemployment rates, and then the right side is after the recession and how those had risen. All the rates were higher if you look at the scales, but just the colors kind of give you an idea on where things got worse relative to other areas. So definitely we've had some challenging periods here in the Midwest, and overall the unemployment rate has come down about 2 percentage points from its peak after the recession, and we've gotten under 8%, and that's something that's a positive, but at the same time it's not anticipated that the unemployment rate is going to drop very quickly. If you look at some of the blue chip forecasts, it's not even getting down to 7% at the end of the year of next year, according to these forecasts still. But even though we've had some more positive numbers recently, maybe it'll be a little lower than this forecast, but still not decreasing as rapidly as you would expect, because we're way above the peak level of from the previous recession, which was around 6%. So this was a much deeper and harder recession. If you look at in terms of gross domestic product, that's the overall level of the economy and adjusted for inflation, you can see that 2% last quarter is still, well, it was 1.3% there. It's just not as strong. Here you can see the 2% growth from last quarter, and the rates of the different areas, the contributions to growth. We like to say from consumption, that was the major one. In residential investment has become a positive again after the big drop there in the last 10 years, and government was a positive contribution again. But when you think about what's helped to get out of the recession, business investment and inventories were a big part of that, but then more recently they've been down, and then net exports had helped to kind of get us going, and now there's been some slackness there. So definitely some concerns about getting the economy moving faster, and that's something that when you have about 2.3% increase expected for next year, we just aren't there yet. We're not going to be able to generate enough jobs to fill that gap in jobs at this kind of a growth rate. And if you compare what we're doing now in terms of growing our economy versus after the two previous deep recessions of our generation, you can see that 1981-82 and 74-75 bounced back much stronger out of the recession. That's something you would expect to see when you have a deep recession. There's a lot of pent-up demand for goods and services, but this time something's different. We just didn't bounce back like that. And if you think about it, a couple of the factors. One is just the uncertainty levels. Uncertainty that, we don't know where the government's going with economic policy, for one. We have a split government, and we'll talk about that a little bit later. But then also consumer confidence. You can see that on the right side, it bounced way down during the recession, and it just hasn't come back to the levels prior to the recession. We just aren't as confident. And I think one of the key reasons for that is there was so much wealth destruction. People got used to having kind of a higher level of wealth in the United States relative to our income, and then a lot of that was destroyed, whether it was in the housing markets or the stock markets. And primarily you can see that here in terms of when you compare net worth versus income, and we got to very high levels prior to the recession, and we aren't going to be back to those levels maybe in our lifetime. And so we are up off the lows. There is some positive generation here, and we can see that in the stock market, for instance, that there's been move upwards over the last couple of years, and we're getting closer to some of those peaks, even though we aren't there yet. Maybe we will now if we can have some resolution to some of the uncertainty in the economy after the election. But the other side is housing, and housing, we aren't anywhere near to the peaks that we had in 2005, 2006, and that boom and bust cycle is the one that agricultural land gets compared to now. And so people are wondering if maybe we're in for this again in agriculture back to the 1980s. So I'll try to address that a little bit, but in addition, we've had a lot of other great speakers on that. But thinking about housing a little more, you can see here that we do definitely have a problem that's spread across the United States in many areas, but it's not even. Some areas are much more hit by the foreclosure rates in red that you can see here, the southeast and the north, or in the southwest in California. But certainly the Midwest has had our problems too, whether it's around Chicago or Detroit in particular, or some of the other regions. But I think rural areas of the United States have been relatively less hit in terms of foreclosures than the urban areas. And you can see on the left that housing starts have come up off that bottom. We're at an area now where we're getting a little traction. There's some positive contribution to the economy from very low levels, but at least we're moving forward in housing. And on the right side, you can see one of the factors that's helping to boost housing is low interest rates. We're at very low levels for home mortgages, but obviously the caveat there is you have to qualify to be able to get a mortgage, and there's been a lot of drawback there in terms of what banks are willing to lend to people and the kind of paperwork and the kind of rigmarole you have to go through to qualify if you've tried to get a refi or have a mortgage. So definitely there's still some work to be done in trying to get through some of the financial problems in housing. At the same time, if we look at manufacturing, it's been a strength for the economy coming out of the recession, and it dipped down a little under 50 on the left, which the Purchasing Managers Index indicates a slowing there, but now it's above again. So there has been some growth, but we have seen slackness in orders for capital goods, which you can see on the right. So there are some issues in manufacturing trying to work through, keep the growth going, but manufacturing has become much more important to rural areas. And here you can see in our district how from 1969 to 2009, non-metro counties became more dependent on manufacturing than the United States overall in many areas. And you can see the white areas being the metro counties, so they aren't included in this particular study. But certainly, when manufacturing does better, that's helping to generate jobs in rural America, and a lot of those are exports. So that's one reason exports have become more important for rural America. The district that we operate in from Chicago includes Detroit and a lot of manufacturing in the auto industry. So here is another key indicator for us that light vehicle sales have gone up significantly, and so there's been some recovery there after the turmoil coming into the recession as well. So industrial production in the manufacturing sector looks to continue about at trend growth next year, about 3%. So that's a positive, but certainly it's not gangbusters. It's not really giving a lot of expansion there. But there have been some jobs created in the manufacturing sector in the last few years. So now I'm going to get to the transition into agriculture a little bit more clearly, because exports have been a huge thing for agriculture. And right here you can see that the yellow line, exports have been rising, and imports, the kind of orangish line, they've been rising a little faster recently, although this year there's been a little bit of a drop in those areas. And so there is some concern there in terms of what's happening with world growth. And here you can see on the right that there have been some revisions down in the growth expected for world economy. And it's partly related to Europe and the economic crisis there with the Eurozone and Greece and Spain and Italy and all those countries having to deal with their financial situation. So there's been some slowing there, possible recession in Europe. At the same time, China's growth has been slower. There's been concerns about that, but it seems like right now there's been some improvement in China in terms of solidifying some of the growth there. And so maybe now we'll see, in the next, in 2013, that world growth would be up above 4% again after dropping down closer to 3% for this year. And when you are thinking about exports and imports, the value of currencies is very important. Obviously, when you look at this chart about the value of the dollar against a range of other goods and services, you can see that the dollar peaked around 2002 in terms of its current range of values, and then it's been dropping overall, although you can see right here that there was a flight to quality in the financial crisis period. The dollar jumped up dramatically, but then it started going back down until last year when the euro was having some more problems, and the dollar was kind of seen as a flight to quality, as a strong currency once again. But generally, we're in the range underneath where we were 20 years ago. We're not seeing the dollar's value be as strong, which actually benefits exports, because when you denominate a sale in dollars, then other people are able to buy that more easily when the dollar's weaker. And here you can see the euro versus the US dollar as well, so it's kind of a similar story there. But global trade is important for agriculture, and it's about 9% of the US exports. And here you can see the numbers on, trade is expected to grow in agricultural goods, even if there's been some slowdown in other areas. But certainly the trend has been very positive, and the US has maintained a balance that's positive in agricultural trade. So that's something that's looking to help boost us for next year. At the same time, it's not always the bulk products that are selling the most on the world markets now, it's high value products. So starting to think about how we can get more high value products into the world is something that's a profit area for US agriculture. And bulk goods have gone up more recently, but a lot of the reason for that is just that prices have gone up dramatically for corn and soybeans and wheat. At the same time, when you look at the actual amounts sold in terms of millions of bushels, you can see a lot of variability there, and really the U.S. is kind of, if other parts of the world don't have it to export, then we have exported more during those times. Although soybeans is kind of unusual in that we've been growing our exports there to China particularly, and so that's kind of been the growth sector. But there is more growth potential when you think about ag exports, and I'll kind of rush through this a little bit, but at the same time, it is worth thinking about, as some of the other speakers have talked about, that there's a lot of growth potential out there because there's demand in the world for food, and here you can see that we have a comparative advantage in the Midwest. We have good quality ground, we have very strong productivity, and so we have ability to help feed people as they move up the income ladder. And what I'm talking about there is that there's a lot of poor people in the world, but there's been growing, that 3 to 4% growth rate in the world GDP has helped to bring people up out of poverty, and as they get to $1 a day, then they start to be able to eat more, and they aren't as malnourished, and when they get to $2.50 a day, they pretty much have their problems solved in terms of the number of calories, but at the same time, they start to want to eat different foods and to diversify their diet, add meats and vegetables more, and oils, and some of the things that when you get to $10 a day, then you're able to kind of move up to the middle class. And so we do see a lot of movement potential as the world's population, even though it's growing, and there's still going to be maybe more poor people, there's also going to be a bigger middle class. So as world economy grows, that's a benefit for U.S. agriculture, and world food demand may even double as we approach 2050. At the same time, there's this growth in the world demand for food. What's happening in terms of the ability to produce it? Well, there are a lot of constraints, whether it's water, arable land, just that the productivity hasn't been as helpful in other parts of the world. So there are definitely a need for the rest of the world to grow more food, but at the same time, I think there's plenty of room for the U.S. to do that as well. And we'll see a larger fraction of food being traded as we start thinking about countries where the high growth is and where the food can be produced. That you need trade to be able to move the food to those areas. And there's factors that are holding back trade. When you think about tariffs, we have lower tariffs here in the U.S. and in North America. You compare that to some parts of the world where they have very high tariffs. And so the trade negotiations around the world could really help agriculture to be more beneficial and as tariffs are lowered in areas of the world where they are high currently. And at the same time, productivity is really going to be growing. Here you can see what's happened in terms of U.S. agriculture over the past 50 years or so. And you know, 2.5 times the amount of output with about the same amount of input. So it's a pretty incredible story that U.S. agriculture has to tell, that it's been such a amazing transformation of technologies and innovations and new seeds and all sorts of different things, new equipment, and that have helped to lower, I mean, the lower inputs mainly is, you know, labor substitution there. And if you look at the region, some of the highest areas in the United States in terms of productivity, including Illinois and over to Ohio. So the Cornbelt has had a very high level of productivity, and that's something that I think we'll see moving ahead as well with some of the new technologies coming out. Now, this chart shows corn and soybean increases over the last 50 years, and up until recently, we've seen some pretty strong increases in productivity there, but of course the drought really hammered the yields this year. So the yields are down, but they should bounce back up in the near future, you know, as long as we get rains and things return to more normal. So we'll have to hold our fingers for that next year. I don't have a weather gauge on me. But when you look at the longer term trends in crop prices, you can see that they've bounced up from the, you know, the drought-induced increases here. But when you think back to the 1970s and 80s, prices were even higher. So these are adjusted for inflation, and so it really is a situation where we have seen these crop prices before, but we just haven't seen them in nominal terms at these levels. So it's really nothing new to agriculture. When you think about the, you know, the high levels of income in the 70s, this makes sense that there were, you know, we made a lot of money in agriculture because prices were high relative to where they are even now. Of course, productivity has helped there a lot, but the reverse side from having corn and soybean prices go up is that the ratios for feed have gone down. So you have here hog corn price ratio on the left, the milk feed price ratio on the right, and those have hit pretty low levels, and so the livestock side of the business has been suffering the most, and they don't have the kinds of crop insurance payments coming this year. But when you account for everything together for agriculture, the finances are in pretty good shape. You think about income for next year, or for this year, excuse me, it's expected to be higher than last year, which was at a very high level, and these are adjusted for inflation. So, you know, the two best years in the last, you know, 30, 40 years are right now going back to the 70s, where you'd have to get higher levels. So definitely there's a lot of positives in agriculture, and we can see them from our survey of land values and credit conditions. This is just kind of a thing, just indicates where we survey, which areas are located. And, you know, farmland values in our survey have risen up over 20% in the last year. You know, kind of easing down to about 15% last quarter, and we'll have, in 2 weeks, we'll have the new number out for the farmland values. But it doesn't seem like there's a tremendous slowing. And at the same time, when you adjust for inflation, you can see that farmland values are now higher in the Midwest than they were back in the 1980 period when they peaked before. But certainly the nominal values are way above that even. And for rents, you have kind of a similar story, but in rents, they're only up to about the levels they were back in that 1980 period. So definitely a stronger comeback for land values versus rents, but they're still rising now when you adjust for inflation as well. So where do farmland values go next? You know, we've already heard some of this talk, and I don't want to belabor it, but certainly the fundamentals are favoring further increases in farmland values right now with the productivity and the high prices. But there is that uncertainty that, you know, we have to think about what's the future and be able to deal with the risks. And one of the risks right now is government policy. You know, the Farm Bill expired, and we don't know what's happening after the Congress, you know, has changed its composition a little bit, but not very much, you know, after the election yesterday, and the president will still have the same policies in all likelihood. So where that all shakes out for farming, it's a little uncertain right now. But there would be, under the current budget environment, expectations that farm supports will be lower than they were under the previous era, no matter how that gets resolved. And at the same time that agriculture is dealing with issues regarding the composition of the new farm bill, we have even bigger issues dealing with tax and fiscal policy in the United States. The fiscal cliff has been mentioned by Ben Bernanke and many others. I don't maybe need to get into the details here, but the general idea is that uncertainty is still something we're dealing with, even after the election now. We still have a political process that needs to resolve many issues, or taxes are going to go up dramatically on 1st of January, and there's going to be big cuts in the amount of spending or cuts to the growth in spending anyway in Congress, and so there's kind of this hammer that's over the heads of the economy right now that if we don't get something done and get some agreement, then we're going to have possibly enough of a cut in the GDP growth that we'll be back down where we were a couple years ago. So we definitely have a situation that it's a dangerous one. And so the Federal Reserve has wanted to help keep the economy growing, and here you can see the liability side of the Federal Reserve balance sheet and how we've had the increases in our balances. But one of the biggest points here is just the amount of excess deposits, that red line, red area there. That's what banks are holding in our accounts that they could use to generate new business in terms of loans. So there's a lot of excess deposits out there, and how that gets pushed out into the economy is going to be something that we monitor very closely, and it's going to, once there's some of that uncertainty is done away with, as people repair their balance sheets, we would expect to see more of that excess deposits generate loans out in the economy. So where are we right now in terms of the Federal Open Market Committee's meetings and how they see the economy going forward? Here you can see that inflation is going to stay in check around 2% over the next 3-4 years. The expectation is that growth will start to increase, especially if we can deal with the fiscal cliff, maybe up towards 3% and 4% growth possible by the end of this forecast period. So the next few years, we would expect to see starting improved growth, but at the same time, the unemployment rate is coming down relatively slower, and it'd take a couple of years to get down below 7%. So how do we get to that kind of a rosy forecast in the Federal Reserve? Well, one of the things was that since the economy wasn't growing as fast as we thought it needed to be to lower those unemployment rates quick enough, we have provided extra oomph to the economy. And so, there's buying of agency mortgage-backed securities on an open-ended schedule, is going to be part of what's called QE3 now, the third round of quantitative easing. And a pledge to resolve that we're not going to lower these purchases until we can see an improvement in the employment outlook. Finally, that those unemployment numbers, once they start to improve, you still might not see us pull back the easing of the economy until they've improved enough to ensure that they're going to continue. So what's that mean in terms of interest rates? Here you can see that the targets are remaining very low for the Fed funds rate, and only about 2015, towards the end of that year maybe, would we start to see them increasing. That's the current expectations of the Federal Open Market Committee. So we're in a low rate environment, and interest rates should remain low, although there will be some movements between long and short probably. But at the same time, it's a forecast that leads us to think that the economy is going to grow a bit above trend next year, and hopefully a bit more than that next year. But there is that big caveat, that slackness in the economy needs to be dealt with, and the fiscal cliff is something that's hanging over us. But certainly housing has turned the corner. Agriculture should be healthy, although the lingering effects of the drought could cause some issues. But certainly world trade, we would expect to pick up more, and that could help to boost agriculture's profits as well. So that's kind of a quick look at where the economy has been and where I think we're heading, and I hope that you found that helpful. And if you have any questions, feel free to contact me. And you know, if you need a copy of the Ag Letter, I do have one left, but you can always find that on our website. So thank you very much.